Before we move on, I just wanted to focus in a little bit more on gold here. I don't think in my career I've seen so much happen, so many bizarre things happening around gold right now. I mean, there's talk of revaluation of gold and whether this would be bullish for the sector. Bringing back, let's audit Fort Knox. Is the gold really there? Does it matter? How many times has it been sold? And then look what's happening on the COMEX right now. Physical deliveries. We've never seen these levels, but there's one thing that's clear. There's a party that wants their gold and they want it now. Couple this with all the gold flying in from London, from Switzerland now, into New York. Is it to avoid tariffs? Is it part of something bigger? I just want to get your thoughts on the gold space, on whether you think there's something it's just bizarre happening right now with gold.
Yeah, I think everyone has a good reason to be nervous because gold, of course, is the mirror image of the global dollar financial system. It's the mirror image. And so if the global dollar financial system is collapsing, then there's every reason to believe that gold and gold demand will soar. And why is the global dollar financial system on the verge of collapse? This also, by the way, happened in 08 and 09. A lot of the same things happened. And it was because no one could figure out how in the world all the investment banks that were failing were not going to just completely lead the world into collapse. What's happening now is not that. The financial system isn't over-levered. You don't have a whole lot of crack dealers that have bought 5 homes with mortgages. You don't have those kinds of problems. The problem that you have is that the central actor in that system is going bankrupt. The federal government of the United States is clearly bankrupt. Absolutely, positively cannot finance its existing debts in any legitimate way. And by the way, has another 200 or so trillion of obligations that are coming due in the next 30 years. You operate on a system of paper money, credit-based money. The credit worthiness of the central actor is paramount, and the central actor is broke. And the central actor is acting like a broke person acts, right? We had a 7% of GDP deficit last year when we have full employment. That's never happened before. And if you look, supposedly Doge is cutting everything, but in the first quarter of fiscal 25, we've already run an $800 billion deficit, which puts us on track for close to $4 trillion in deficit spending this year. It's just completely insane. And so the rise in gold is the market's legitimate response to the collapse of the U.S. financial system. And that's based on the fact that our federal government is bankrupt. Now, Trump wisely is trying to do everything he can to save this system. So he's trying to implement tariffs to generate a lot more revenue for the government without killing our economy. But whether you call it an internal tax or an external tax, it's still a tax. And so one of the things I think is actually positive is that during the recent correction in tech stocks, and I think, the Mag 7 is maybe down 5% so far. During this retreat in tech stocks, we have seen for the first time in a very long time that U.S. Treasury bonds are rallying. And I think that is the market now beginning to tilt to believe more in what Trump is doing. In other words, that the odds of either a massive inflation or austerity, and before, the price of gold just soaring was just the market believing the only way that the government was going to handle their bankruptcy was just through printing money. And that's why gold's up 50% this year. Now the market is saying, well, wait a minute. If Doge can cut $500 billion this year, $1 trillion next year, if he does do 25% tariffs, then you could see a really big economic contraction in the U.S. And that austerity would mean that bonds are going to rally significantly. And the best way to judge where the 10-year bond yield should be is by adding what you expect real GDP growth will be. And the real GDP growth in the U.S. has been around 2.5% for a long time. And you add that to what you expect the inflation rate to be. And we can argue all day long about what the real inflation rate is. Let's say 4% is a fair number. So if you have 2.5% growth and you have 4% inflation, they get you a bond yield of 6.5%. And I think that was the base case for most of the market going into this week. If you look at why Stanley Druckenmiller was short Treasury bonds, it's because, right now the yield is at 4.5 and he thinks it's going to 6.5. And that means a big decline in the value of those bonds. Okay, but if we have austerity and there is no growth, instead real GDP is, say, minus 2%. As a result of the decline in growth, inflation rate drops to, say, 2%. Well, now you've got the math for a 10-year Treasury yield that's back down below 2%. I don't know what's going to happen. Like I said, I can't predict the future, unfortunately. But what I can tell you is that the market has a way of making the most amount of people the most embarrassed. That's just the way markets work. And right now, I would say that long U.S. bonds is probably the single most out of favor investment idea of all. And so I think you'll probably see much better returns in long-dated fixed income in the U.S. over the next 12 months than anybody expects. And the way that could happen is if Trump actually delivers on cuts to government spending. Now, listen, that is a market forecast, and I think from a market standpoint, that all makes sense. But I will tell you something else, Daniela, which is that I will believe that the U.S. government cuts spending when I see donkeys fly.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.